Okay, in our last session, we finished up Chapter 3 and began Chapter 5 and began talking about itemized deductions. So I wanted to get an opportunity to kind of review what we did, do a couple of problems before we move forward from the point of where we stopped. We started off with medical expenses. Medical, you should have this handout that we're working on, and we're going to finish that, begin to continue to work in that handout. But medical expenses are deductible up to, but limited to 7.5% of your AGI. So basically, you take your qualified medical expenses, and then you subtract any insurance reimbursements you may have had, and and then subtract from that 7.5% of your AGI, and then that would represent the deductible portion of your medical. And then we looked at what would qualify as medical expenses, the medicines and drugs, and just as long as they're not illegally purchased or illegal drugs or over-the-counter drugs. Then we also looked at capital expenditures, the possibility of taking a deduction for capital expenditures. And then we looked at mileage, which is 19 cents a mile, and then your transportation for your medical. So we started with looking at our medical, and then we went to our taxes. We can deduct state and local taxes paid or withheld from your from your paycheck, or you can use a tax table, or you can use the actual amount. So we looked at that in property taxes. Your real estate taxes are deductible on your home and a second home. When you sell a home, you want to make sure that you split those taxes between the buyer and the seller. And then you can take a deduction on personal property tax, which would be on your autos, your boats, or your trailers if it's based off property value. And then we looked at interest. Deductible mortgage interest. It's deductible in the year that's paid, and if you are the person who is obligated to make that payment. And it is deductible for loans up to $1 million on your home and a second home. And then for home equity loans, you can deduct the interest on loans up to $100,000. And then points are deductible. And if they are points from a refinancing, you have to capitalize those and amortize those. So you can't take a straight deduction for that. So what I wanted to do at that point, let's look at a Schedule A real quick. And then we're going to do a couple of the mortgage problems just to look at how that calculation goes. Once again, here's your Schedule A. That's where your itemized deductions are taken. You have your medical and dental expenses, where they're going to be limited to 7.5% of your AGI. Here's your taxes paid. You either check the income taxes, meaning the withheld amount, or you check the box for sales taxes, your real estate taxes, and then your personal property tax. Often what goes, let me blow that up a little bit. Often what goes on this other tax line is if you're filing your 2008 return, and if in 2007 you owed and you paid an amount with your tax return, which would have been filed on 4/15 of 08, then that amount is also deductible on Schedule A. So if you, when you filed your 2007 return and you owed on that 2007 return, you can take a deduction for the taxes that you owed and you paid with your tax return that was filed in 08. So that's the deduction on your 08 tax return. Also, let's look at the interest paid section. And so here we have our interest paid. You take your home interest mortgage, and you can take it there. There's two separate lines, one for if you received the 1098 and then one if you did not. And then line 12 is your points. And then I'll briefly mention the qualified mortgage insurance premium, and then we also look at investment interest. We'll also look at that today. So let's start off by, in the back of your text, there is some problems. In the back of your chapter, there's some problems, and I want to just do a couple just so you can get an understanding and some clarification on the mortgage interest, and that it's limited to $100,000 of for your home equity, and it's limited to $1 million. So if in the back of your book, if you look at page 5-40, and we're going to do problem 11 on page 5-40. So page 5-40, and we are going to start with number 11 here on that page. Okay, it says Janet and James, they purchased their personal residence 15 years ago for $150,000. Their home has a fair market value today of $425,000. For the current year, they have $80,000 of first mortgage interest on their home, on which they paid $5,600 of interest. So they have a first mortgage of $80,000, and they paid on that $80,000 first mortgage $5,600 worth of interest. They also have a home equity loan for $150,000. They paid interest on that home equity loan of $12,000 for the year. Okay, and so on the first mortgage for their residence, where it was an $80,000 loan, and they had interest of $5,600, they can get all that. There's not a problem with them getting that. Okay, on the home equity line of credit, or the second mortgage on their home, they have $150,000 debt or loan, and that's a problem because they're limited to $100,000. So what you want to do is you have to take the $100,000 that they're allowed, divided by the $150,000, which is what they actually have. Excuse me. Then you multiply that times the $12,000 worth of interest that they received on that. So that makes their deduction, opposed to getting the full $12,000, they're only going to get $8,000 on that one. So in that instance, they would get $5,600 on the first mortgage, and then on their home equity line of credit, they would only be able to get $8,000. Okay. Also, let's look at number 12. Number 12. Helen paid the following amounts of interest during 2008. She had mortgage interest on her Dallas residence that had a loan balance of $50,000. So $2,000. So on the Dallas residence, she was okay with that. $2,025. And then automobile loan interest, personal use only, for $440. That is not mortgage interest, and she can't take interest on an automobile loan. So she can't get that. Mortgage interest on her Vail residence with a loan balance of $50,000. So you can get mortgage interest on your home plus a second home. So she can get the Vail residence of $3,050. And then Visa and MasterCard interest. You cannot take consumer or personal interest. So the amount of mortgage interest or interest she would be able to deduct on her Schedule A would be $5,075. So $5,075. Okay, I want to do one more before we move on. 13. Okay, on 13, Mark owns his home and has $250,000 mortgage related to the purchase of his residence. When his daughter went to college in the fall of 2008, he borrowed $20,000 through a home equity loan for his house to help pay for her education. The interest expense on the main mortgage is $15,000. So the interest on the main mortgage of $15,000 would be deductible because it's $250,000 on that mortgage, and on your main mortgage you have up to $1 million in debt in which to get that. And then on the home equity loan, it's $1,500, and that loan was only $20,000, so she can get that full amount. So the amount of on the home equity would be okay. So the total deductible amount of mortgage interest would be $16,500. Okay, so that brings us. So we covered medical, we covered taxes, and recovered interest. The last thing that we picked up on was our education loan interest. That was the last thing that we covered, was our education loan interest. so you can see that. And you can take up to $2,500 per year. There's a phase out for high income taxpayers, and that's only for qualified expenses that you paid out of that, which would be tuition, room and board, and related expenses. Now, that is not a Schedule A deduction. That, even though it's listed here and listed in this chapter, it is not a deduction that you take on Schedule A. It is a deduction that you take on the front of your tax return. So let me see if I can get you there so you can see that. It's a deduction that you take on the front of your tax return. So notice this is the front of our 2008. We come up with our total income, and then we have these deductions. And listed in these deductions is your student loan interest deduction on line 33. So that is where you deduct that. It is not deductible on Schedule A. So even though it's listed in that chapter, it is not deductible on Schedule A. Okay, so that gets us to pick up where we left off in our textbook. So we want to pick up on our investment interest. We want to pick up on our investment interest, which is on page 510, on the bottom page of 510. Investment interest is a Schedule A deduction, so it does appear on your Schedule A deduction there. So on line 14, your investment interest, and there's a form 4952 if that's required for you to fill out. Okay, while we're looking at that, they talk about there that qualified mortgage insurance premiums, qualified mortgage insurance premiums, and it says see page A6. And there's just a little bit that I want to briefly read to you that comes out of the Schedule A and B instructions. So for your qualified mortgage insurance premiums, enter the qualified mortgage insurance premiums you paid under a mortgage insurance contract issued after December 31st of 2006 in connection with home acquisition debt that was secured by the first and second home. And then it tells you to see prepaid mortgage insurance. And so just know this has to do with qualified mortgage insurance. So, and they normally say it's mortgage insurance that's going to be provided by the Department of VA or Federal Housing Administration or a rural housing service or a private mortgage insurance company. So know that if that sounds like something that you've purchased, it's not covered in the book, so you may want to go to either the Pub 17 or you can go to the instructions for Schedule A and B, in which they'll give you a lot more detail. It gives you a whole section of qualified mortgage insurance premiums. So it's nothing that we're going to actually cover, but I wanted to make you aware of where you can find that information. Okay, so now we want to pick up on our investment interest. We want to pick up on our investment interest. So let's start there. Okay. Investment interest is when I go and borrow money, and I use that money that I borrow to invest in an investment property. And so I like to give a little visual here. I have my loan, and I am going to borrow some money. And then that money that I borrow, I want to use it to purchase. Okay. I want to use it to purchase investment property. So I'm going to want to use that to purchase investment property. Some type of investment property. Okay. And in doing so, this investment property hopefully will yield me some investment income. Okay, that's the whole purpose of for it to yield me some investment income. And then in the meantime, I'm going to be paying interest on this loan. I'm going to be paying investment interest on my loan. Okay, so therefore, that's how we get to this investment interest deduction. So it is basically debt that's used to purchase investment property. Okay, so it's debt that's used to purchase investment property. Okay, and it's going to be, that deduction that I get is going to be limited to, the deduction that I get for my interest is going to be limited to what we call my net investment income. And then it's also, I can get a deduction for interest. It's not going to be allowed for tax exempt property. So let's say I take that loan, buy something that's tax exempt. So that income is not going to be taxable to me. They're not going to let me take the deduction for the interest if the income is not going to be taxable. So it's not allowed on tax exempt. Okay. And then when we're talking about our net investment income, basically we're going to take our investment income minus any investment expenses that's attributable to that. Okay, so let's look at, they have a exercise here in the book at the bottom of page 510. We have Karen, who borrows $150,000 at 12% interest on January the 1st of 2008. The proceeds are used to purchase $100,000 worth of raw land and $50,000 from a CD. During 2008, the CD pays interest of $1,500. Karen incurs expenses attributable to the investment property of $500. And so of the $18,000 interest that she paid on the $150,000 loan, $1,000 of it would end up being deductible. You take your investment income of $1,500 minus the investment expenses of $500. So her deduction is going to be limited to $1,000. So the unused can also be carried forward. Any unused, so that in that case, that unused $17,000 is going to be carried forward. So any unused is going to be carried forward in future years. So even though she didn't get to take the deduction that year, any unused is going to be carried forward. Okay, let's do a problem in the back of the book. In the back of the chapter, I keep saying the back of the book. We want to, there was another one I wanted to do, number 9. Number 9 that's also on page 540. So let's look at that one and do that one together. Okay, number 9 on page 5-40. Matthew borrows $250,000 to invest in bonds. During 2008, his interest on the loan was $30,000. So we have $30,000 worth of interest that we want to be able to deduct. So we have $30,000 worth of interest that we want to be able to deduct. Matthew's interest income from the bank is $10,000. So the interest expense was $30,000, but the income from the bonds was $10,000. The income from the bonds was $10,000. So basically the deduction ends up being $10,000. So you only can make a $10,000 deduction here on Schedule A, and the $20,000 will be carried forward. So the $20,000 will be carried forward. Okay, so that is your investment interest. That's your investment interest, which is deductible on Schedule A. Deductible on Schedule A. Next, we want to move to our next section, which is contributions. Contributions is pretty involved. They seem pretty simple, but as we get into these details, there's a lot of details that most people aren't aware of because we don't meet these limitations. There's a lot of limitations that have to do with contributions, but most of the times we don't meet them. So we as just common, regular tax return individuals we don't run into them, but we're going to cover all those limitations and we're going to cover all the rules today so that you'll be aware of them, so that it may become a time that you may need to consider them. Okay, contributions, basically, when we first begin to look at contributions, what we're talking about contributions made in cash, so we're looking at cash contributions, or property, so we're going to look at property as well. So we're going to look at cash contributions and property as well. And then what we're looking at is out-of-pocket expenses. You know, what I paid for out of my pocket, so out-of-pocket expenses. And then also, I can deduct my mileage, you know, as I work or have to drive to do charitable things. And that one thing we want to stress is that you cannot deduct your time. So even though I can deduct the mileage for going somewhere, but I can't take a deduction for my time or the use of property. You know, if I let them use my property, I can't deduct that, you know, for that. So as we look at contributions, we're going to be looking at contributions that are made from cash or contributions of property. We have a lot of that. Our out-of-pocket expenses, we can deduct those. Our mileage, we're going to look at those. But we cannot deduct for our time and the use of our property. We cannot make a deduction for that. There's some limitations, as I said, that we're going to look at. There's some, the basic limitations is that 50% of your AGI. So you're going to be limited to 50% of your adjusted gross income. I can't make a contribution or have contributions more than 50% of my adjusted gross income. There's some contributions that are going to be limited to 30% of the adjusted gross income. And then there's some that are limited to 20% of the adjusted gross income. So we'll be looking at those limitations. Also, in order to get a deduction, it has to be to a qualified recipient. So it has to be a qualified. A lot of times you hear them say 501c3 organizations or 1c3 organizations. And so it has to be to a qualified recipient or 501c3 organizations. And on page 5-11 in our textbook, they talk about what are some of these qualified organizations. So let's just look at some of them. The U.S., a state or political subdivision thereof, if the donation is made exclusively for public purposes. Okay. Domestic organizations formed and operated exclusively for charitable, religious, educational, scientific, or literary purposes, or for the prevention of cruelty to children or animals. Church, synagogue, or other religious organizations. War veterans organizations. Civil defense organizations. Fraternal societies operating under a lodge system, but only if the contribution is used for one or more charitable purposes. And then certain not-for-profit cemetery companies. And so they give you a list of those qualifying organizations, but also in publication 78, that's the pub, so make a note of that, you'll get a more detailed list of those organizations. So if you're not sure if you are contributing to a 501c3, you can go to the irs.gov and look up publication 78, and it should give you a list. And we know that's constantly changing and constantly being added. In order to be a 501c3 organization with the IRS, you have to file papers with them, and they have to grant you that. Now, there is some... also some that we cannot contribute. If you look at the top of page 512, let's write some of those, some that are non-deductible contributions. So just keep in mind these, if you make contributions to these organizations, they're going to not be deductible. Gifts to non-qualified recipients. So that's the first one. If they are non-qualified, not just listed, or we just read the qualified. So if they're a non-qualified recipient or organization, you cannot get a deduction for them. Also, contributions of time and service. Once again, they list that. Contributions of time and service. So I want you to be aware those are not. Time and service. And let's add use. The use of property. The use of your property is also. 3, contributions where there's a benefit received. Contributions where there's a benefit received. For instance, if I contribute to my church and I get a benefit of my children going to school for free. So that's a benefit, meaning that I got free tuition, so they're not going to allow that to be deductible. And then the last one, they say wagering losses. such as church bingo. So I'll just issue church bingo. If I'm technically playing bingo, then that's not going to be deductible for me, even though I'm paying it into the church. I'm paying it into the church. So you want to be aware that there is some limitations. What goes along with those limitations are substantiation rules. I have to have some type of verification that I made the deduction. I have to have some type of verification that I made the deduction. So there's some substantiation rules that I have to be able to substantiate my deduction. Okay, if I am making a contribution of less than $250. Okay, then what I need for those would be a bank record or a canceled check. Running into my other words. Canceled check. So some type of bank record or canceled check. And if it's $250 or more, so basically anything under $250, a bank record, so my canceled check or a statement or something. If it's $250 or more, I need to have a written acknowledgement from the organization. Okay, so if I give, for instance, $5,000 to my church, canceled checks won't be enough. I'm going to need a statement from my church. And so that's a law that, or a requirement that's been in there for, I'd say, three years or so. So I'm often stressed to churches that it's important that they provide statements, because there's a $250 limit. If I only gave $250 to my church, then the canceled checks would be enough for me. But if I've given $250 or more, then I'm going to need a statement from the church. The canceled checks won't be enough. Okay, if I have a contribution of $500 or more, then I'm going to need a form that I'm going to need to fill out, 8283, which is going to add some detailed information. And then if I'm making a contribution of property of $5,000 or more, then I'm going to need an appraisal. So if I'm making contributions of $5,000 or more on property, then I'm going to need an appraisal. So that's going to be important to do. Okay. Now, one thing that has really changed, I would say, in the last couple of years was the donation of cars. You see billboards and you see things that says donate your car, donate your car. And a number of years ago, and I must stress, a number of years ago, it used to be that you donate your car and you get a deduction of the fair market value of your vehicle. If that is going to be over $5,000, then you needed appraisal. So what was happening is that people were donating cars and they were taking the $5,000 deduction because of the mere fact that I didn't need an appraisal for that. So anything over that, I would need an appraisal. So everybody was donating cars saying $5,000. So the IRS had to restrict those rules some. So they changed the rules a little bit when we're dealing with cars and when we're dealing with vehicles. So when we're dealing with vehicles, let's look, make a couple of notes. Okay, the rules are a little different. First of all, the deduction cannot be greater than the sale value to the charity. Okay, so if we're talking a car, then the deduction can't be greater than the sale value. The other thing is if they don't sell it, so what's going to have to happen is once they sell it, then they'll have to let you know via a written statement what the sale value is, and then that therefore would be your deduction. Now, if it's used You know, maybe I donate it and they just use it in the organization, or it's given to the needy. A lot of times they get those cars and they give them to people who are in need. Then in that case, you can take the estimated value. You can use the estimated value of that car. So they've kind of got pretty restricted on the cars. They kind of got pretty restricted on the cars. So just be aware of those rules. And there's something that they talk about, the huge increases or the changes they made. Let me get to that page so you can read that. At the top of page 5-15, top of page 5-15, they say tightening the rules for the charitable donation of cars caused the dollar value of deductions to drop 80% in 2005. So that's when they made the switch. So it's been 3 years. The first year under the new rules, the dollar amount of charitable deductions for automobiles were approximately $2.4 billion in 2004. So 2004 old rules, donate your car, take the fair market value. Long as it's not over $5,000, no appraisal needed. So everybody probably took $5,000. 2004, the rules changed. 2004, they say you can take a deduction, but it has to be equal to the sale value to that charity. So if you donate a car, the charity sells it, they're probably not going to get $5,000 for it. So you have to take whatever they get for the sale, or if it's used or given to the needy, you just get a deduction for estimated value. So now in 2005, the deductions were $407 million. So it went from $2.4 billion in value to $470 million. So it was an 80% drop. So those tightening those rules. So they did exactly what they needed to do. As you can see, it changed the deduction. It didn't stop people from making that contribution, because it's an excellent contribution, but it limited what they were taking. It limited what they were taking. Okay, so those are kind of the basic rules of contributions, okay? It begins to get a little more difficult when we're contributing property, Because remember, contributions are, you can make a contribution of cash, which we looked at, and you know, over certain amounts, you have to have substantiation. Property, which is what we're getting ready to really kind of deal with now. And then we mentioned mileage. Mileage is 14 cents a mile. I don't think I mentioned the amount. So for charitable purposes, you can take 14 cents a mile on your property. Okay. So we want to look at percentage limitations on page 512. We want to look at percentage limitations on page 512. Now, the way I go over this section, because it is pretty confusing, and when you read your text, the text is confusing. So we're going to read what they say in the book, and then we're going to interpret it by our handout, what we put in our handout. Okay, so I'm at the bottom of page 5-12. It says, generally, a taxpayer may deduct total contributions in may not deduct total contributions in excess of 50% of a taxpayer's adjusted gross income. So bottom line, I think I've already mentioned, you can't get more than 50% of your adjusted gross income. The 50% limitation applies to donations to all public charities, all private operating foundations, and private non-operating foundations. If they distribute their contributions to public charities within a specified time period. Okay. Gifts to other qualified organizations, such as certain private non-operating foundations, fraternal societies, veterans organizations, as well as gifts for the use of an organization, are limited to 30% of adjusted gross income. So they made a switch from what was 50% to what was 30%. Okay, so what was 50% to what was 30%. And then they have some special rules there. Okay, so basically, when we're dealing with property, you can look at, you're going to be looking at the fair market value. And generally your deduction is going to be the fair market value. Generally the deduction is going to be your fair market value. So generally that's what your deduction is going to be on property. Now, when you I don't want to say it, when you make a contribution of property, they want you to look at, well, what if I would have sold it? If I would have sold it, would it be short-term capital gain, or would I have gotten long-term capital gain? So that's going to make a difference of how you make the deduction. So let's look back on page 512, and it's up at the top in your first paragraph. If cash is donated, the deduction is equal to the amount of cash. Nothing different. For donated property other than cash, our general rule, which I just spoke to you about, is the deduction is equal to the fair market value of the property at the time of the donation. So most likely fair market value generally at the time of the property, at fair market value of the property at the time of the donation. The fair market value is the price at which the property would have been sold had there been a willing buyer or seller. There is an exception to this general rule. So general rule is the fair market value. The exception is if the property would have resulted in ordinary income or short-term capital gain had it been sold on the date of the contribution. In that situation, they tell us the deduction for the contribution is going to be equal to the property's fair market value less the amount of ordinary income or short-term capital gain that would have resulted in the sale of the property. So let's go back to our handout. So the general rule is that property donated, you generally get a deduction of fair market value. So my deduction is generally the fair market value. Now, if I sold this property and I would have gotten, or it would have been ordinary income, meaning if I sold it, it's ordinary income, just regular income, or it would have been short-term capital gain if I sold it. Okay? Given that, then the deduction is going to be fair market value minus the ordinary income or short-term capital gain. So you're going to have to take the fair market value minus what the ordinary income or short-term capital gain would have been. Okay? So if it's ordinary, and basically when we talk about ordinary income, what I mean is if I'm in the business of selling art, that's what I do. So when I sell art, I sell it and I get ordinary income for it. It's my regular business, ordinary income. So if I contribute some art, I'm in the business of selling art, and that contribution is going to be the fair market value of the art minus what the ordinary income would have been if I sold it. So that's what they mean by that. Let's go on. If the sale of the property would have produced a long-term capital gain, then the deduction is generally equal to the fair market value of the property. Okay, so let's go back to our notes. So if the sale would have been long-term capital gain, then the deduction is the fair market value. And once again, that's a generally, because there's going to be an exception to that. Okay, so generally that deduction would be fair market value. However, the fair market value is reduced by the amount of potential long-term capital gain if the deduction is made to a certain private non-operating foundation, or the donation is to a contribution of tangible personal property to an organization that uses the property for a purpose unrelated to the organization's primary purpose. So they say, okay, let's go back to our notes. Generally, when you contribute property that would have been long-term capital gain when you sold it, you would get the fair market value. Okay, now the exception is if it's donated to certain organizations, which they listed, and I won't list them on my handout, certain organizations, or if it's not used for its intended purpose. So it's if it's used, we'll say for an unrelated purpose is the way they state it. So if that's the case, then the deduction is going to be the fair market value minus the long-term capital gain. So instead of getting just the fair market value, it's going to be the fair market value minus the long-term capital gain. Let's look at page 5-12 and the example on page 5-12. Jean Gino B. donates a painting acquired 5 years ago at a cost of $4,000 to a museum for exhibit, when the painting's fair market value is $12,000. If Gino had sold the painting, the difference would have been the sales price, $12,000, minus her cost, $4,000. And so $12,000. It would have been sales price would have been $12,000, and the cost $4,000 would have been the long-term capital gain. It says the deduction, therefore, she gets is $12,000. She's going to be able to get the fair market value. It's not going to have to be reduced for appreciation, since the painting was put to the use that was intended to. A painting is intended to be put in a gallery. So she paid $4,000. Could have sold it for $12,000, so there was an $8,000 capital gain in there. Didn't have to reduce the fair market value by the $8,000 capital gain because it was donated to an art gallery and used for its intended purpose. Therefore, the deduction is the $12,000 fair market value. If we go ahead and continue, if the painting had been donated to a hospital, the deduction would have been $4,000. Because if it's donated to a hospital, then the hospital's purpose is to take care of people, not to display art. So it's not donated to a organization that's going to use it for its intended purpose. It's going to be for an unrelated purpose. So therefore, given that, the fair market value of $12,000 has to be reduced by the long-term capital gain of $8,000, and therefore would only end up getting a $4,000 deduction for that. So those are what those rules are. Okay, let's look at a problem on page 5-40. I believe there's another one back there that relates to this. Okay, 14. Let's look at 14. On page 5-41, actually. Okay. On 14, Barbara donates a painting that cost $5,000 3 years ago to a university for display in the president's office. The fair market value of the painting at the date of the gift was $7,000. So she paid $5,000 for it. The fair market value at the date of the gift is $7,000. Okay. If Barbara had sold the painting, she would have had a gain of $2,000. Okay, which is the difference between her sale price and her cost, and that would have been long-term capital gain. Okay, so her contribution deduction for this donation, it's either the fair market value or the fair market value minus the gain, which in this case is a $2,000 gain. The issue is that she donates the painting to a university. Universities are in the business of educating. So and it was to be displayed in the president's office. So given that, her deduction is going to be the fair market value minus the $2,000 long-term capital gain. And so therefore her deduction only gets to be $5,000. So that is how that works. All right, let's continue to our other limitations. And I think I picked up reading this first, and I was reading in the wrong place. So let's go back to our limitations, which appear at the bottom of 512. Okay, so our limitations that appear at the bottom of page 512. So we have certain limitations, and then any of those limitations, any excess can be carried forward for 5 years. So as we talk about those limitations, if you don't meet those limitations, they can be carried forward for 5 years. Okay, so here is our rule. So I'm reading at the bottom of page 5-12. Now these are the ones that really get confusing. I think I began to read these last time and I jumped back up. So now I'm at the bottom of page 512 under percentage limitations. Generally a taxpayer may not deduct total contributions in excess of 50% of the taxpayer's AGI. Okay, so this is we start off with the general rule. The general rule is that deductions, charitable contributions, deductions, are limited to 50% of the AGI, and that's our general rule. Okay, so that's what generally happens. Okay, and then this 50% limitation applies to donations to all public charities, all private operating foundations, all private non-operating foundations. Okay, as long as they contributed and do what they're supposed to it. Now, if we have donations, I'm going to cover just the 30% and then we'll stop. If we have donations made to public and private charities, so as long as they're in that realm, we're okay. I'm having a problem spelling today. Okay. So we're okay if they're made to those particular organizations, and so then they go and say gifts to other qualified organizations such as certain private non-operating foundations, fraternal societies, and veterans organizations, as well as gifts to use for other organizations, are limited to 30%. So that's when we hit our 30% AGI one. So as long as they're made to public and private charities, we're okay. But then it's 30% for donations made to private non-operating foundations. And then they had some other ones list. It's going to be 30%. So what we'll do, because this gets pretty detailed, we'll pick up here and start back at our percentage limitations. Make sure you read through those and read those examples, because we're going to go over those examples. And then we'll do a problem or two in the back of the book. So we'll stop there on the percentage limitations for contributions. It's pretty detailed. Read through it so that when we get back together, it will hopefully make sense to you as I explain it. Thank you.